James, this is one of those scenarios where fear may be permeating through some investors' minds. Is it justified? Should investors be fearful and worried about what's happening right now, or will calmer heads prevail?
That's a great question. I'll break it up into two parts. The first one, the short answer is on the economy, yes, there needs to be some degree of caution because we, quite frankly, it's not going to exactly clear, the ISM data coming out yesterday, how much the economy could conceivably slow in the second half. But on the AI front, some of that growth is slowing, as Bob pointed out, but we're also in this huge transition phase, and there's this uncertainty as far as how much of these AI investments will actually accrue into returns for these companies over time. And I think that there's a lot of uncertainty around that, a lot of questions on that on the earnings calls. But I think that's the area that investors should not be concerned with. I think that this AI transition, we don't know exactly how it's going to develop, but a lot of people are thinking about this in terms of linear type of growth. And really, I think investors need to think about it in terms of exponential type of growth. And I think that is going to prove really well. But unfortunately, that's a multi-year type of thing, and that does lead to choppiness as we go through this transition.
What's interesting, I laid out at the beginning of this hour and the half-hour mark here, the investor question, the debate that some are having about whether the AI trade has, quote-unquote, peaked. It doesn't sound like, based upon your commentary, that you believe it's peaked, that it's got a long runway. But how do you project some of those returns to play out in the coming, say, year?
Yeah, when you look at it on a one-year basis, obviously a lot of these stocks have run. We've been saying for some time now, at least the last month or so, that we've been pulling from 2025 returns. And if you're looking at stocks for the balance of 24 and into 25, a lot of these stocks, a lot of it has been driven by multiple expansion over earnings expansion. And so that's why, I think discretion, more discipline, valuation discipline over the short term is necessary. I mean, big tech, I don't think that the rotation is completely done out of big tech. So we're actually looking at more other sectors, despite our huge innovation bend in our portfolio, to broaden out because of the uncertainty around the economy and the kind of the exceedingly high valuation for some of these companies.
Okay, because you opened the door, before we let you go, what other parts of the market look attractive to you if there is a hypothetical continued rotation out of big tech?
Yeah, so the way we think about it is, what is the most predictable revenue streams that we can find right now? We're looking at software services. I think that's going to do well on the tech side, but we're also looking at areas like that'll benefit from the interest rate cuts, like financials, looking at utilities, staples. We're broadening out a barbell approach between tech and non-tech, and also looking at more smaller cap names.